You keep money in a bank account. The bank often calls it free, but free for you does not mean free for the system. So where does the bank's money actually come from, if not from a monthly charge on your statement? This video maps the machine, not which bank to choose, not what to buy, just how everyday accounts sit inside a profit system. This is educational content, not financial advice. We're explaining how the system works, not telling you what to do with your money. Banking is infrastructure. Most of us interact with it every week and still only see the surface, an app, a balance, a fee line item when something goes wrong. If you only see the surface, two myths stick. Myth 1. If there's no monthly fee, the bank isn't making money from me. Myth 2. Banks only make money when they charge people who mess up. Both miss the main engine. Retail banks sit in the middle of other people's cash. They gather deposits, they fund loans and other earning assets. They also sell services around that core pipeline. Let's map three engines. Start with the oldest engine, maturity and rate transformation. In plain language, borrowing short and cheap from depositors and lending longer and higher to borrowers. You place money in checking or savings. That deposit is a liability of the bank. In many products, the interest the bank pays you is low, sometimes near zero on transaction accounts, while the bank can earn more when it lends or invests. Here's a simplified illustration, not a quote from any bank's current rates. Suppose $10,000 sits in an account paying 0.5%. That's about $50 a year in interest cost to the bank. Now suppose $9,000 of that funding supports loans earning 6%. That's about $540 a year in interest income, before credit losses, operating costs, and capital. The gap between what the bank earns on assets and what it pays on funding is the heart of traditional banking. Real banks also hold securities, keep liquidity buffers, suffer loan losses, and pay for branches, apps, compliance, and staff. The toy math is only a map, not a profit guarantee for any institution. Industry analysts track this with net interest margin, or NIM. Net interest margin equals interest income minus interest expense divided by average earning assets. In other words, of the assets that can earn interest, how wide is the net spread after the bank's own interest costs? According to the Federal Deposit Insurance Corporation's quarterly banking profile remarks for the fourth quarter of 2024, the U.S. banking industry's full-year net interest margin was 3.22%. In the fourth quarter alone, the industry net interest margin was 3.28%, 5 basis points higher than the prior quarter, and the FDIC noted that figure sat above its pre-pandemic average of 3.25%, measured from 2015 through 2019. Why did the quarterly margin rise? The FDIC explained that short-term rate cuts meant interest expense fell faster than interest income for a time. Funding got cheaper quicker than asset yields reset. That's a systems point most ads never mention. When policy rates move, both sides of the bank's balance sheet move, but not at the same speed and not for every product the same way. For full year 2024, the same FDIC remarks put industry net income at $268.2 billion, up 5.6% from 2023. That is the industry, not a recommendation about any bank stock or any consumer product. It simply shows the machine can be highly profitable even when individual customers see zero monthly fee. Interest is not the whole story. Banks also earn non-interest income, revenue from fees and services that is not primarily interest on loans minus interest on deposits. The Federal Reserve Bank of Cleveland has described how a large fraction of bank revenue can come from non-interest income, including familiar items like overdraft-related charges and ATM fees, alongside many other service lines. For consumers, the fee lines that feel personal are usually account service charges, out-of-network ATM fees, overdraft or non-sufficient funds-related fees, card late fees on the credit side of the house, wire and specialty services. Some of those lines have been under heavy public and regulatory scrutiny, and the totals have moved. The Consumer Financial Protection Bureau reported that combined bank overdraft and NSF fee revenue in its dataset was about $5.83 billion in 2023, down more than half from about $11.96 billion in 2019. That's a structural change in one fee channel, not the death of bank profitability. The spread engine still runs. Other fee and service lines still exist, and even after the decline, billions of dollars still flowed through overdraft and NSF charges in that year. The CFPB has also noted that some institutions still charged overdraft fees as high as the mid-$30s per item in the periods it studied, while other institutions cut or redesigned programs. Policy is not uniform. The map is: fee design is a product choice inside a larger revenue system. On credit cards, a related but different product, the CFPB found that late fees peaked at over $14 billion in 2019, fell to about $12 billion in 2020, and later, materials citing supervisory Y14 data put late fees around $14.5 billion in 2022. The Bureau also noted that in 2022, consumers paid a record high about $130 billion in credit card interest and fees combined, with late fees representing more than 10% of that total in the framing of its late fee work. Again, this is not never use a card. It's the incentive map. Late fees and interest are designed features of revolving credit products. They are part of how that product line earns money when balances revolve or payments slip. Every time you tap or swipe, more than your bank is in the room. Payment networks, merchant acquirers, and card-issuing banks sit in a stack. Issuers can earn interchange-related economics and other card fees as part of that stack. Merchants pay for acceptance. Networks coordinate rails. Banks issue cards and fund rewards programs from product economics. You don't need the full wholesale pricing schedule to see the point. Convenience is a product. Someone pays for the rails, sometimes visibly in merchant prices, sometimes inside bank product design, sometimes both. Even a simple checking account is a payments hub. Direct deposit in, card out, ACH bills, peer payments. The account is not only a vault, it's a switchboard. Switchboards get paid. We will not map every interchange basis point here. Those contracts are complex and change. The system's takeaway is enough. Everyday free transaction accounts live on top of payment rails that generate fee income somewhere in the chain. Walk through one ordinary month for a fictional person. Call them Alex. No advice. Just flow. Week 1. Paycheck hits the account by direct deposit. The bank now has low-cost funding. Week 2. Alex taps a debit card at a grocery store. Payments infrastructure moves. Merchant-side costs and issuer economics exist whether Alex notices or not. Week 3. The bank's loan book, funded in part by deposits like Alex's, earns interest from other customers' mortgages, auto loans, or credit lines. Week 4. If Alex has a credit card with the same or another bank and revolves a balance or pays late, interest and possibly late fees enter that product's P&L. If Alex overdrafts a deposit account under a bank's program, a fee line may appear, depending entirely on that bank's rules. None of this requires a monthly maintenance fee to make the overall franchise valuable. Maintenance fees are just one optional dial. That's the map. 3 dials, 1 customer relationship. 0 monthly fee can be rational business design when the relationship produces spread, payment economics, or cross-sell of other products. The cost of serving the account is real: software, fraud, compliance, customer support. So the institution recovers it somewhere in the system. A bank heavy in credit cards can show different margin economics than a bank heavy in low-rate mortgages. Industry NIM is a useful compass, not a clone of any single brand. When one fee line shrinks, as overdraft and NSF revenue did from 2019 to 2023 in CFPB reported data, the deposit-to-loan engine remains. Institutions adapt product design. The map changes shape. It rarely disappears. Slogans say, if it's free, you're the product. In banking, a clearer line is, if it's free on the sticker, the economics are elsewhere on the relationship: funding value, fees, payments, or future products. That framing is less catchy. It's more accurate. Recap. Engine 1. Interest spread. Deposits fund earning assets. Net interest margin measures the industry's net yield after funding costs. Full year 2024 industry NIM, 3.22% per the FDIC. Engine 2. Fees and non-interest income, service charges, card late fees, overdraft-related revenue, and more. Some lines have fallen sharply, others remain large in absolute dollars. Engine 3. Payments. Your account is a switchboard sitting on rails that generate economics for the stack. If this map was useful, the next videos will keep charting systems most people use but few can draw, credit scores as infrastructure, inflation as a silent tax, and why complexity itself can be a business model. Subscribe if you want the map, not the hype. This was educational content only, not financial, investment, tax, or legal advice. Nothing here is a recommendation to open, close, buy, or sell any product. Your decisions are your own.